let's start the Ohlson-O scoring. Let's make it with the bold, because in this case we can see that how does it work. And after that, so first of all, we would like to make this simple and easy and hard to make a mistake. So let's copy everything from here, and hopefully, yeah, it will put it into different lines. And after that, we just have to add the data for the different years. Yeah. Okay, so total assets. We just have to fill in, so nothing extraordinary is necessary. So from the profit and loss statement, data. Yeah, so you can see that these are not the same. It should be the same, but this is not accounting class, so that's why we are using total assets. Yep, and total liabilities, just the liabilities. We can ask the question that in this case, should we add the other liabilities? Because we excluded it already. So let's say that now we just add the transparent current liabilities, total liabilities, and these two things will be I don't want to care about them, because I have no idea what is about or in these categories. ArianeSpace was not transparent in this case, so let's say that not less. Okay, current liabilities. Okay, current liability is the payable. Current assets. So again, only the transparent ones are added, as we did it during valuation. Okay, did we have a year when the total liability was bigger than the total asset? So practically it means that the equity was negative. Luckily we did not have anything, so it will be always 0. If it's not 0, then we died. Pre-tax profit. This thing here. And if the net loss of the last year, 2 years was... Did we have the net loss? Nothing, so let's say it's 0. Okay. Then, after we filled in the simple things, then let's see the gross national product. What is this in the case of France? So good that it's still Hungarian. Save data. Yeah. What do I need? Gross national product. It's a US dollar. So cute. Okay, let's use this one. And this is billion. So if I'm adding this here, this will be million. But it's US dollars, so we have to convert it back. $1.6.
Do we have to use the exact convert rate, or you said
Yes.
1.
1. Okay, you are right. Practically, we just have to, this value is just used to represent the size of the company, so yeah. But you are right, so we should use the 1-1. Okay. Working capital. Okay, what was that? Yeah, current assets, current liabilities, okay. Then practically this is coming from this minus this. Okay. And funds from operations. Oh, this is what I hate. This is coming from the cash flow analysis. Cash flow from operations. Plus we have to add the depreciation. And nothing more because we have no further items what can be given. Yeah, nothing more. Okay, so if this company would be much more precise, then we would have a cash flow report. And what just happened here? Yeah, okay. But no, not okay. Let's do this again because I'm not sure. So EBIT plus depreciation. Yeah, these are, I don't know which numbers were referred, but but now it's good. Okay, so we did this one. Then here comes the big equation. So in this case, it's very much easier to say that let's still generate the subcomponents. So let's say that we need this one. We need the total liability. Minus total assets, and also to make things even better, because I'm absolutely lazy, and let's add all the multipliers. Because in this case we are just calculating all these things here, then multiply it with these numbers, and after that sum it up and we will be happy. Minus 9 VC per TA. Because otherwise we can just hit everything into the as an equation into the Excel, but if we are making any mistake, then it will be impossible to find it, or really hard, and that's why what we learn here today is to see that how can we not mess this up. So baby steps. Next. Okay. Okay, this one's supposed to be negative. Okay, in this case we can understand why the Alt-1Z is much more popular, because it contains a small amount of variables, not a long thing like that one. If you see any mistake what I'm doing here, then please mention, because and also there is this number which is also negative, and this is the constant. Yeah, so constant, negative, positive, negative, positive, negative, 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 positive, negative. Okay, so there is no mistake here. Then let's have no mistake here as well. So log total assets divided by the total gross national something, and then we should multiply it with this number. And now we have something. And also, let's fix it with the dollar mark, and after that we can just scroll it through here. Also we need this one, so not forget about that. F4. Then total liabilities divided by the total assets, and then we have to multiply this one. What? No. I don't need have. Come on, go back. Okay, we shall have to start this again. So this one multiplies total liabilities divided by total assets. So these are all the coefficients from the Ohlson-O function. If you have any question, please ask, because that's why I'm sitting here. So. VC divided by total assets. Still, we need to fix it, because if we are not fixing it, then the coefficients start. Maybe we still have nice numbers, just not the proper ones. Okay, current liabilities divided by current assets. So we just have to use everything what is here. So right now we're just checking that. This thing multiplied x. Practically we could just sign here zeros, but what happens if it's not zeros? Net income divided by total assets. Yes, of course.
These coefficients which we are multiplying on, they're representing what exactly? What is the...
So when the Ohlson-O score was created, they fitted all the... So they were fitting logit regression on US public listed company dataset. While my sister was born, and this year, and then practically this is coming from the, so this is regression coefficients, regression betas.
Okay, and they're pre-calculated for these specific variables, right?
Yes, yes,
okay,
yes.
And always the
yeah.
same.
Yes. If we would be really precise, so if you would be paid for this work, we would do a bit difference, because in this case I would say that, okay, let's check French companies, so let's download a data set of French publicly listed companies from the stock market or from elsewhere, and after that let's fit the same variables on them. And let's see that, okay, let's download data, so half of the sample would be companies which went to default, half of them which did not went to default, and after that the logit regression would calibrate itself on the sample. But we did this 2 years ago, 3 years ago in Central Eastern European samples, and the coefficients were really close to this one. So mostly we can do the calibration to be precise, but this is a really good approximation.
Okay, but in general they are adjusted to the local stock market, right?
Yes, yes.
Okay.
So if we are doing this as a job, then it's always much better if we are calibrating it to the actual set of companies. But in this case, it would require an additional 3 hours to do that stuff. FFO divided by total liabilities. And this number is also multiplied with a huge 0. Oh, I hate this part. So we need to multiply a huge bracket. Okay, so right now net income minus the previous net income, where there is no data, so in this case we have to be creative somehow. Let's close this one, and let's say that we have to insert a new column. So we have to define a year 0, because otherwise this will not work at all. The easiest way is, let's say that, okay, this is constant. So we did not change anything since the past year. So the first component will be 0, because this number minus this number will be a problem, but in this case we can use the same function for the next years as well. So and divided by absolute value. So how profitability increased in absolute terms since the last year? Obviously that is a huge 0, but after that we can see that, yes, it's nice. So now we can say that, okay, let's zero this out, and after that all the other functions are performing well. And finally we got the O score. Sum up everything here. Let's make it italic, because in this case it will be good. And then I'm always suspicious. I think maybe this is in the wrong order. Let's check it, because yes, exp O score is divided 1 plus. Yes, so this is a plus. Okay. Because otherwise we will have really strange values. So exp divided by 1 plus exp O percentage mark. Okay, so we can see that the probability of default will be this, and this is the default company, so without any modification. So now hopefully it goes to P2. We can copy everything, or at least the functions, P2, so at the same location of the origin, and paste special form not formulas. Yes. Please be no. Okay. So, unfortunately, we have to remove this thing. Case study default setup. If I'm copying the formula, why are you copying also the location of the file? But okay, so Control F, replace case default something, replace all. Done. Oh my god. What happened here? T minus 1. T minus S. T minus S. I can't see the bug.
Why is there is the bug? Because it is there.
Yeah. so suddenly the probability of default jumps a lot. Because it punishes me that that the profitability increased from compared to the previous year. So why this is bad for me? It's negative, so oh, this is plus. This is a bug. Oh. So this is a bug, not a feature. Yeah. You are 0, but you are not. That's why we are. So one thing is about checking and automatizing everything in Excel, but also we should never forget that we are economists, so we should check that if we are able to see something which is strange, then okay, sample, but I need the other one, the other one, yes. So this is a plus. Yes, now they are dying. Good. Okay. I mean, sad. Just. So, if we are comparing the probability of default, let's just add the numbers. Probability original, just to see and highlight our performance here. Let's give it bold because so, the end result of this half an hour is that now we can see that what is the added value of the new strategy. So not just the value of the company increase because this is the new value. If we are going back to the original one, then we can see so now we can see that yes, the original value, so this is the added value of the strategy from shareholder point of view, but still we need to see that yes, but what are the risks here? So at least we can see that the stressfulness of the company decreases. Obviously in the first year, because I changed so many things, so changed the whole product line, and things will go explode. So the probability of realizing any revenues are way higher, or sorry, way lower. Then that's why this probability of default is high. But after that, the new strategy starts to be implemented, and after the third, fourth, and fifth year, we will be good. So at least we can show it to the shareholders if they are not happy that what is happening in the first year, that this is all the part of the plan. What can possibly go wrong? Cool. Then let's write in to the sample assignment. So sample assignment 2. I think it's much better to extend the first one because practically the initial problem is the same, and we just have to see that what happens, because we can remember that the book said somewhere, so techniques of assessing country risk. And one was quantitative analysis. Techniques like regression analysis can be applied to historical data to assess sensitivity of business at various risk factors. So practically we are doing something like this. Just it's definitely not a Delphi technique, it's not a checklist approach, and it's not inspection visit, so it's quantitative analysis. Okay. For probability, maybe we should add page break. This is heading 1. Do we using bullet points? Yes, we are using bullet points. So okay. So the Ohlson-O score shows, indicates, it's always better, indicates increased default probability in the first business year. Maybe it's easier if we are copying already this thing, not here, here. For the first business year, due to the rearrangements, the new launch vehicle. I like this phrase is that it's never a rocket. It's always launch vehicle. If it explodes, it's never explosion. It's an anomaly. So yeah, phrases. Rearrangement of the new launch vehicle. Sorry, lower. Generate. Oh my god. Generation. But after the second year, lower cost levels and higher launch cadence, launch number, will reduce the probability of default. Why? Because obviously if you are looking on the balance sheet, then we start to sit in a lot of cash. So if we have a cash reserve in the 5th year of like 1.1 billion euros, who cares about default risk anymore? So so we reduce the probability of default due to the accumulation of cash reserves. Just mentioning it, so it's not the job for today, but this is always a huge danger for companies if they are increasing their cash reserves so much. So right now, this is not a publicly listed, in this scenario they are a publicly listed company, but in real life the company is private and it's owned by two big owners like the Airbus and Safran engines. So practically there is no danger that there will be a hostile takeover, but if there would be a public listing, in this case, some hedge funds are focusing on cash-rich companies and they are always trying to buy the shares. So usually what they are doing that they are buying 9% of the shares, but also they are using other banks to buy 9% of the shares on their behalf, because until you are under 10%, you should not announce that you are a significant shareholder. So you are buying shares also in friendly hands. You are doing everything from loan, so it's not from your own money. And once there is the annual shareholders meeting, then suddenly everybody votes in the same direction. You are firing the board of directors, and after that you are sitting in your own people, and after that you are highlighting that now you are a significant shareholder, and after that you are taking out the cash reserves, paying back the loan which required for the acquisition, and still you can have some nice profit. So this is a highly hostile takeover, but a lot of money. Yes. So usually what they are,
to be rich.
it's dangerous to be rich, let's say. So risky. So what you can do in this case, that you are trying to remove the cash reserve. So for example, you can start to buy back shares. So you are converting cash to shares, because in this case you are increasing share prices. So the price of a hostile takeover. So if they can see that there is a lot of cash and they can buy back. So the little combination is when the share prices are low, and also the cash reserves are big. So there is this sausage factory in Szeged, the pig factory. They were publicly listed, and the same thing happened with them. That they planned to open a new meat processing plant in Romania, and they had a new partner in Switzerland in the late 90s, in early 2000s, and the whole management was absolutely engineering focused. So nobody cared about the business and then the financial part. So this whole hostile takeover was completely sudden, a new thing for them, and they did not prepared. They created the cash reserve for expansion, and after that the whole company was, I cannot say sucked dry, but practically it was completely dried out from liquidity until it was purchased by Bonafarm from the takeover company, so from the hedge fund.
But it is, if you are a private company, it is not a threat at all, right?
Yes, because it's, in this case, in a private company, you have to negotiate with the shareholder. So you are not able to buy shares under the radar. There is always a way of convincing some people, and also similar thing happened in the case of the mall. which is this big oil company in the region, that ÖNV tried to buy it in 2006. And there was a huge war in the stock market, so at that time I started my activities in the stock market, and it was ridiculous that shares was increasing by third in that year. So if we are going back to a lot, so this was the organic growth phase, and this is somewhere in the middle. So here in 2006 it started to increase, but it was really rapid. So until this point they were increasing, the share prices were increasing because they acquired the Slovnaft in Slovakia, the TVK, which is a plastics manufacturing company, or the INA or part of the INA in Croatia, which did not end it so well. But anyway, so they were in a growing process, and ÖNV started to buy up shares by using investment banks in the UK and elsewhere, and so there was a huge competition between the local management and their friends. So OTP started to purchase also shares on behalf of the MOL group, and after that they removed all these shares from the market because they created convertible bonds, and these convertible bonds kept it for a decade long. So it's really funny that it jumped, and some of my friends purchased shares. I was saying that, okay, once I realized what is happening, it was already, so it was jumping from 20,000 to 30,000. And at 30,000, its story ended because liquidity dried up. So you can see that there was a huge trade volume, and after that, nothing at all. So it emptied the market from shares, and after that, even the subprime crisis happened. So yeah, and it was a funny story. But in this case, the management was able to win because it's an oil company, so you are sitting on cash all the time. So okay, yeah. So accumulation of cash it's a good thing. Just we should be careful sometimes. Or also you can say that, okay, let's buy up other companies. So let's diversify our operations. Like I mentioned at the lecture, that let's purchase something which is creating satellite components or something which is relevant for our business, and it can also generate its own cash flow. But we are proud of our core competencies, so we did all this thing. So now let's see what happens in the case of inflation. Costs. Also cost of sold goods. And we have to program in also some inflation curve. So how can we prepare a business plan for inflation? In this case, the easiest thing is that let's use the wisdom inflation forecast. So ECB inflation forecast, because that's why we have central banks. Yes, please send me the cookies. Because maybe we could model our own inflation, but who cares about this one? So now we can see that what is the most current projection for inflation. So we can see that, okay, if the simulation starts in 2022, so let's say that we are using these numbers here. Inflation. So we have 8.4 up percentage mark, because otherwise it will be problem. 3.2, 2.1, and we don't have further data, but the objective would be 2%, so let's say that finally they can achieve what they have here. And it's always funny that these expectations are always changing dynamically. So we can see that what was expected in June. So now we can see that inflation, oh, here is decreasing, here is, it's still increasing. But in the long run, we are assuming that we will die out. Okay, so it's pessimistic. So this one is developing. But also we should work on interest rate as well, because now it's really funny that the real interest rate is negative. So we should update this one with some numbers. We were not able to see it, but let's assume that the company is AAA rated, because I remember that way. French government corporate bonds. Once it will load in, then we can go to curves. Yes. And now we have the AAA. So obviously it's not AAA rated, but a AA rated company, because, yeah. If you are looking on the probability of default, which is not visible here, but it's visible here, so this is far from AA. So let's say that it's B. So all this data is an average of AAA rated companies. So we could click in, and after that it would say that which companies were aggregated, but let's say that, okay, we believe this. So there is no force here, but we can somehow get this one, not? Yes, we can get this one. Okay. Okay, what is the difference between yield and zero rate? Practically is that in the case of zero rate, all the additional payments are removed. But we can see that usually the difference is not so much. But this is what we can use at a reliable level for interest computation. So profit and loss statement. But this is the same useless company, so we can say that it created a serious effect. Also, if you are checking, the real interest rate is still negative. It's still negative here. So maybe after 3 years, the interest rates will be bigger than inflation. So it's still okay. So we did the adjustment of the data, and then let's see that how can we deal with this. So first, if we are also increasing the revenues, then it means that the company is an oligopolistic market. So we are not price takers, we are price makers. If we are just increasing the costs, then it means that we are in a competitive environment. This one must be increased and this one must be increased. Depreciation, we should not increase it. So these two components can go south because this is the aggregation of these lines. Yeah, so we have to change these things. Okay. So first let's see the optimistic scenario. Multiply 1 plus the inflation, not the interest, the inflation. So we just have to change the revenue, and let's see that we have higher revenues, but also at the same time we should add the following modification. To here as well. Okay, there was only multiplication here, so I did not mess up anything. Okay, and then is already 1, so let's remove it. Why is this? Ah, this is a fixed number. Scusi. We have to fix this. Now it's good. And let's highlight it somehow that it was affected by inflation, so let's give it a green color. Because now we can see that this is inflated. So what? Let's say that price level. It's not a, it's italic. Okay, for the first year it's okay that it's increasing by this, but after that this plus, so it's always additive. So now it's moving upwards. Okay, so this is our multiplier, ladies and gentlemen, before that was a rookie error, but numbers were increasing, so that's why. Just when I was able to see the wages, that oh, it's increasing, but why is decreasing further and further? Because yeah, the inflation is decreasing. Now they should suffer more. Yep. Profit of the year. One assumes that the company is has an oligopolistic market status only. So inflation affects both the expenditures and revenues. Can follow it. Why the other? Assumes a price taker behavior. Ah, it's not British, it's English. Okay. Price taker behavior, and only costs are increasing, but these are not. So the original company, or the original strategy, is not affected as much, but the price taker scenario. Removes profitability completely. The new strategy performs well only if the company is in an oligopolistic status. Otherwise, the first years losses will be not compensated by increased future revenues, because practically our profit margin will be destroyed by inflation. So this is the sad reality. And also we can say that in the case of inflation, let's move this up, because this is referring to the other scenarios as well. So profitability, we should remain big and significant on the market. Otherwise, if there will be a bigger and bigger competition, so that's why we don't want to be in a competitive market. So if you are looking at it from corporate point of view, by adding macroeconomics to the microeconomics, then yeah, this is struggling, this is happiness and sunshine. So if you have to find the difference between the two market models, this is it. Okay, value. In this case, we can say that I can close this one, and let's have the value. Okay, this one is absolutely ugly, so left, no, right. So in this case we can see that which one is what. And we should never do the politician thing that we are cutting the axis line here in 3000, and after that we just increasing the differences. So it should start at 0, and then we can see the proportions. So value. Value was also higher only in the oligopolistic case. So the company must avoid price taker status. Because yeah, you can lose a lot of money. So practically this is halving the equity value. So this is really harsh. And the last thing, probability of default. The price taker scenario. The probability of default remains at the original levels. The corporate performance will be stressed. Distressed, stressed, in stress, stretched. Yes. So the sad thing is that, so I made this the first version 2 years ago, and nothing improved with this company. So even the delays are way longer, they lost even more markets. It's so sad. And also, SpaceX now they published that Starlink reached the 2nd million customer base, so 2 million customers, and in this year they doubled the customer base of their satellite internet business. So practically now they start to get more funds from satellite internet than from launching stuff into space. So it's also repivoting practically that if you need stable cash flows, then launching stuff is right now not the greatest deal. So we are somewhere like the aviation was in maybe in the 40s, 50s, so before the jet age, when the mass supply of flights was possible. Just yeah. Okay, safety environment is way better than in the 50s or 60s. Just yeah. Okay, so that's all for today, ladies and gentlemen.